We all need to make smart decisions with our money. The Long-Term Investor podcast shows you how by distilling complex financial matters into easily digestible lessons. And now, here's your host, Chief Investment Officer at PlanCorp and the author of Making Money Simple, Peter Lazaroff.
Inflation is everywhere in the media, and for good reason. Inflation erodes the purchasing power of money over time, and historically, U.S. inflation averages about 3% a year. And that average number includes periods of higher inflation and periods of lower inflation, but if we assumed a flat 3% rate of inflation every year, our purchasing power would be cut in half roughly every 27 years. In my opinion, the primary reason someone is a long-term investor to begin with is to grow their savings at a rate greater than inflation. Growing savings at a rate greater than inflation has been fairly easy the past 2 decades, since inflation has been well below its historical average and barely ever reaching 2% in most years since the financial crisis. But we all know inflation has picked up quite a bit since the pandemic. On February 10th, the Labor Department reported that U.S. inflation accelerated to 7.5% over the last 12 months as strong consumer demand and pandemic-related supply constraints continued to push prices higher. You don't need to be an economist to realize that this headline number is a big deal for Wall Street and Main Street. But as someone who works on Wall Street and lives on Main Street, I'm here to tell you why I'm not particularly worried about the recent uptick in inflation. In today's episode, I'm going to start by explaining the inflation number being reported and what categories of the economy are driving it. Then I'm going to give you 7 reasons why you can feel a bit more optimistic about the inflation we're seeing. And finally, I'm going to share with you a framework for thinking about inflation going forward in your portfolio. So let's dive in. The gauge being used to report inflation is Consumer Price Index, or CPI. CPI is a measure of the average change over time in the prices paid by urban consumers for a market basket of consumer goods and services. It's easy to find flaws in the baskets of goods methodology or the shortcomings of measuring only urban consumers without considering the wide range of consumer demographics, but overall, CPI does a reasonably good job of showing us the trend in prices for goods and services. And there's no question today that prices are going up. BlackRock had a really nice graphic from the prior month's inflation report that shows the different weightings of goods and services within CPI, along with what categories drove prices higher. And I'll be sure to put that graphic into the show notes on thelongterminvestor.com. But I'll also highlight a few things that stick out to me. Looking at the data for the 12-month period ending on December 31st, 2021, there's a few things that stand out. Housing carries a 41.6% weight in the CPI, and that category increased 5.1% with a very notable increase of 23.9% in the lodging away from home subcategory. Transportation has a weight of 17.1% in the Consumer Price Index, with a particularly notable increase within the category for car and truck rentals, which increased a whopping 36%. Food makes up 15% of CPI, and it was up 6%. And within the food category, meats, fish, poultry, and eggs were up 12.5%. And again, you can see the entire graphic in the show notes by visiting thelongterminvestor.com. But the point I'm trying to make here is that inflation impacts everyone differently, depending on what you're spending your money on. And I want you to keep those categories in mind as I go through these 7 reasons that I'm not particularly concerned about the inflation we've seen recently. Now, I realize that some of these points won't apply to everyone, but they do apply for our clients at PlanCorp as well as my average follower based on past feedback we've gotten from show listeners. Number 1, averages are made of highs and lows. Inflation's historical average of 3% includes times when readings fall below that level, as it has for most of the past 2 decades, and times when it's higher than average, as it is today. This is simply the winding path inflation takes to an average outcome. Its path takes far fewer twists and turns than, say, stocks do on their path to an average outcome, so it's easy to notice big shifts like we've experienced during the pandemic. But there's no reason to panic. even with the large uptick in inflation over the past 12 months, 5-year inflation is still just 2.92% through the end of 2021, and 10-year inflation is only averaging 2.14%. There's no doubt that inflation at this high of a level for an extended period would be harmful to the economy, but the Federal Reserve is already showing a willingness to tighten monetary policy to make sure that doesn't happen. Bond market prices, which reflect the opinions of all market participants, are showing expectations of 2.8% average inflation over the next 5 years and 2.14% average inflation over the next 10 years. So even though it does appear that the rate of inflation will remain elevated for a period of time, let's not forget that that's all part of a long-term average rate of inflation that was ideally included in your financial planning analysis and modeling to begin with. Reason number 2 that I'm personally not that concerned about inflation right now is that inflation is good for the economy. Inflation is not a bad thing. In fact, it's a sign of a healthy, growing economy. Here's what happens in an inflationary environment. When prices are going up, people expect prices to continue rising, so they want to buy now rather than pay more later. This increases demand in the short term, and as a result, stores sell more and factories produce more. They're more likely to hire new workers to meet this demand, and thus starts a virtuous cycle boosting economic growth. The alternative to rising prices is falling prices or deflation, which is far worse. Here, consumers and businesses hold off spending to wait and see if prices will drop more before buying. Why purchase something today if it'll be cheaper in a few months? This cuts back demand and businesses reduce their inventory. As a result, factories produce less and lay off workers, which reduces demand even more. Then businesses lower their prices, which makes deflation even worse, and the negative feedback loop continues. Historically, it's been very difficult to break a deflationary cycle, and it's really been deflation that the Fed has been fighting for the past decade plus, so that prices rising now in this way could even be viewed as a victory of sorts for the economy. Reason number 3 that I'm personally not as concerned about inflation is that inflation leads to higher wages. One of the key ingredients to an inflationary environment is wage growth. Most successful professionals get a raise each year that at least keeps up with the rate of inflation. Your human capital, or your capacity to earn, is arguably the most effective inflation hedge. If your wages keep up with inflation over the long term, then your ability to purchase goods and services remains intact. So I'm still working, and this trend is working in my favor. Plus, higher wages provide a boost when you have fixed costs like a mortgage, which brings me to my next point. Number 4, inflation is good for borrowers. Inflation makes debt less costly. So if you have a mortgage or commercial loan, you're paying back debt with dollars that are worth less now than the dollars you received from the lender in the first place. When inflation exceeds the cost of debt, i.e., the interest rate, it's often referred to as free money because you're repaying the bank with dollars that are worth less than the cost of the loan. When the debt is a fixed rate, the benefit is even better. And because I have a mortgage and a commercial loan, inflation benefits those liabilities on my balance sheet. And reason number 5 is related to how inflation benefits the asset side of my balance sheet. So here we go. Reason number 5, inflation is good for homeowners. If you remember the statistics I read at the start of the episode, one of the biggest areas contributing to the recent uptick in inflation is housing. I happen to own a home and don't need to buy another home, so I'm benefiting from the increase in property value. And as I just stated before, I'm also benefiting from the falling cost of the debt associated with my home. So inflation strengthens my financials as a result of being a homeowner. And if you own a home, this is also a reason you can be optimistic about the higher inflation. On to reason number 6, stocks protect against inflation. If the vast majority of your savings are in cash, then high inflation is particularly harmful. But for me, nearly all of my savings are in stocks, which have historically outpaced inflation by a wide margin in the long run. During inflationary environments, corporations pass on higher prices to consumers, which in turn boosts revenue and earnings. Going back to 1928, both U.S. dividends and earnings have grown roughly 5% a year, while inflation has averaged about 3% a year. And that's really a large part of why stocks have outpaced inflation over the long run. Number 7. Inflation is already here and there's nothing you can do about it. Here's the thing. A lot of people have been asking me, what should we do about inflation? And reason number 7 is just that. Inflation is already here and there's nothing you can do about it. Trying to hedge against something that has already happened doesn't make a lot of sense. It's sort of like buying home insurance while your roof is on fire. It's going to be very, very expensive. So if you're looking to do something in your portfolio to protect against inflation, I'd say you're probably too late. And that's why it's so important to have a financial plan and portfolio in place that takes into consideration all possibilities in advance. If you can completely remove prediction from your process, then you can focus on things within your control, which are the things that make the biggest difference in the end. That's all I have for today. Please be sure to subscribe to the show on your favorite podcast platform, and remember that all show notes are posted to thelongterminvestor.com. Until next time, to long-term investing.
Thanks for listening to the Long-Term Investor Podcast. To access free financial resources and submit questions to be answered on the show, visit thelongterminvestor.com. Peter Lazaroff is an employee of PlanCorp and BrightPlan. All opinions expressed by Peter and any podcast guests are solely their own opinions and do not reflect the opinions of PlanCorp or BrightPlan. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of PlanCorp and BrightPlan may maintain positions in the securities discussed in this podcast.